is call options chain data so complex to read? Imagine trying to read a map with dozens of roads, landmarks, and traffic signs all at once. That's what analyzing call options chain data can feel like. It's packed with information that can seem overwhelming at first glance. When you look at an options chain, you see rows of data for different strike prices and expiration dates. Each row shows multiple pieces of information that all influence how the option might behave. For each call option, you see the bid price, which is the highest price buyers are willing to pay. Then there's the ask price, the lowest price sellers are asking for. The last price tells you the most recent trade. Volume shows how many contracts were traded during the current session, and open interest indicates how many contracts are still active and not closed. Implied volatility is a forecast of how much the stock price might move in the future, and it affects the premium you pay for the option. Then there are the Greeks, which are metrics like delta, gamma, theta, vega, and rho. These measure how sensitive the options price is to different factors. Delta shows how much the options price will change if the stock price moves. Gamma measures how delta changes as the stock price changes. Theta indicates how much value the option loses each day as time passes. Vega shows how the options price reacts to changes in volatility, and rho measures sensitivity to interest rates. Adding to the complexity, you have to understand the difference between intrinsic value, which is the real value if you exercise the option right now, and extrinsic value, which is the premium paid for potential future gains. All these elements interact in ways that can be hard to follow. For example, if implied volatility rises, the extrinsic value increases, making options more expensive. Liquidity also plays a role. The bid-ask spread, or the difference between the highest bid and the lowest ask, shows how easy it is to buy or sell that option. A wide spread can mean less liquidity and higher trading costs. Traders need to analyze all these factors together to get a clear picture. They look at different strike prices and expiration dates, compare bid-ask spreads, and interpret the Greeks to understand potential risks and rewards. Understanding call options chain data is essential for making smart trading choices. Whether you want to buy calls to bet on a stock going up, sell calls to generate income, or create spreads to manage risk, you need to interpret this data accurately. It's a lot at first, but with practice, it becomes a powerful tool. The complexity comes from the sheer amount of information packed into each row and how all these pieces influence each other. Once you get the hang of it, reading options chains becomes a valuable skill for any trader.